This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Welcome back to now the second chapter of our discussion with James on general M&A issues that people should be aware of from a commercial perspective. And in this chapter, we'll be speaking to James about the process from the drafting and negotiation of the sale agreement all the way through to completion. So we're now at a point where we've done our due diligence. What happens next, and when do we get stuck into what you guys love doing, and that's the detail of a sale agreement?
Yeah, my favourite part. It's pretty common to start preparing the sale agreement and even some of the other key transaction documents at the same time as due diligence is going on. The sale agreement is certainly the most significant and often the most heavily negotiated document in an M&A deal, and it's customarily prepared by the buyer's lawyer, but that's not a rule, and it's not uncommon for the seller's lawyer to prepare it too. It's generally a pretty long and detailed document. It will cover everything from purchase price mechanics to adjustments, to conditions precedent, things that have to happen before completion can occur, restraints, warranties and indemnities, termination, confidentiality, tax matters. There was probably a bit of jargon in that, sorry, but they're the types of things that a sale agreement will typically deal with.
Yeah, well, that's there's jargon everywhere in this area, and we'll talk about some of those things. So, I noticed, James, with clients, particularly if they're the seller, probably the part of the sale agreement that they fixate on the most is the bit that tells them how much they're going to get paid and when and in what form. So, can we talk a little bit about what would be some of the common purchase price structures that you would see in a deal?
Yeah, so for a share sale, which we probably do more often than asset sales, the most common structure we see is a completion payment to be paid by the buyer at completion, and then what's called a completion accounts adjustment method, which really involves a working capital adjustment as well as a net debt adjustment. And the way it works is that you have a headline sale price that is calculated based on the target business being cash-free and debt-free, and based on a normal level of working capital. And then following completion, an adjustment is made to take account of the actual amount of the cash and the debt and the working capital at completion to arrive at the final purchase price. So that might be higher or it might be lower than the headline amount that you started with. But that is probably the completion accounts mechanism that I just described is the most common one that we see in Australia. There is another mechanism less commonly used in Australia, which is, as I understand it, pretty common in Europe and other parts of the world, and that's referred to as a lockbox mechanism, which in many ways is simpler than the completion accounts mechanism. You basically agree upfront a purchase price amount based on a recent set of accounts, ideally or often audited accounts, and there is no adjustment other than for what's called leakage, another bit of jargon there, which is really certain transactions or payments that are prohibited between when the lockbox date was agreed and completion. So it tries to avoid the financial situation of the target changing too much from when the price has been agreed. And they're the main two purchase price adjustment mechanisms that we see on these sorts of deals in share sales.
I'm sure you'll agree that when it comes to, well, either of those sale mechanisms, but especially the completion accounts adjustment mechanism, that clients and us as lawyers will very much be leaning on the expertise of either the company's in-house finance function, if it has one, or its external accountant or auditor, or in many cases, both. So that's when an accountant can very much expect themselves to be in the picture. And the other thing that we hear about a lot, and we see in a lot of agreements, is earnouts. So there's lots of tax around earnouts, and we'll be talking about that next time. But can we just summarise what earnouts are about and what that expression means?
Yeah. So earnouts are really a way of bridging the gap between buyer and seller expectations around price, particularly where the buyer is concerned about the future performance of the business that they're buying. And the way it works is that specific performance targets are set, usually or often tied to EBITDA. And if those targets are hit in the period following completion, whether it's a 1 or a 2 year period, then the seller will be entitled to a further payment. And that payment is calculated based on the actual performance, often capped at an agreed amount as well. So yeah, that's what earnouts are. We're certainly seeing more earnouts in recent times, which probably makes sense given all of the uncertainty in the world since COVID and all of the other things that are happening. So yeah, they're definitely flavour of the month at the moment.
Yeah, I mean, I think they're generally perceived as a way of a buyer hedging their risk a little bit by making their future payments subject to how the business performs after it's changed hands. But a little like you say, as good as earnouts are, especially for buyers, they can also be ripe territory for disagreements and disputes as well. And on that topic, sadly, it probably segues to the next discussion. But I think one thing we should talk about a little bit is warranties and indemnities. And oftentimes, when you look at a sale agreement, most of the pages seem to be taken up with warranties and indemnities. So can we explain to the people listening what warranties and indemnities are generally all about and what some of the things they need to be looking out for are?
Yeah. So warranties in the context of an M&A transaction are really just a fancy word for statements of fact by the seller about the company or business that they're selling. For example, it might be, the warranty might be there are no current claims in respect of the business, or the seller owns all of the intellectual property relating to the business. And a long list of these types of statements are typically set out in a warranty schedule in a sale agreement. And the purpose of that is to reassure the buyer about what they are buying. To the extent that any of these warranties turn out to be incorrect at the time they were given, then the buyer may be able to make a claim for loss against the seller. So that's kind of the 101 on warranties in an M&A context. It's probably also worth mentioning, Frank, that it's customary to have a sometimes very long list of qualifications and limitations on these warranties in a sale agreement. Things like the seller won't be liable if the claim isn't made before an agreed expiry date, which is often 12 or 18 or 24 months after completion. The seller isn't liable if the claim is below an agreed de minimis threshold, or the seller isn't liable if it's above a maximum cap, which is often tied to the purchase price, 50% or 100% of the purchase price. And importantly, the seller isn't liable if the particular matter that relates to the warranty has been disclosed to the buyer, for example, in the data room or in a disclosure letter to be given at completion. So you have a long suite of warranties, but they are qualified and limited by other things in the sale agreement. So there's a bit to warranties.
Yeah, you're very much so. And the other side of the coin, in a way, is indemnities. So what are those all about?
Yeah, so indemnities are, again, they're about risk mitigation, but they're a little bit different in that in basic terms, they're typically reserved for specific risks that are identified by the buyer during due diligence. And, it might be that a particular ongoing litigation is discovered, or a tax issue, or an underpayments issue. And as a buyer, because of the severity of that issue, then you will require in the sale agreement a specific indemnity that shifts the risk of that particular issue from the buyer to the seller. And importantly, these specific indemnities are typically, and again, there's no rules on this, but customarily in negotiating these sorts of transactions, these indemnities won't be subject to the same suite of limitations and qualifications that we were just talking about in relation to warranties. So there might be 2 or 3 specific indemnities in an agreement where the effect of them is basically that because of their significance, the risk is shifted from the buyer to the seller for that particular risk.
Excellent. So, I mean, the short point of all of that, as far as I'm gathering, James, is that warranties and indemnities are basically a risk management mechanism that operates through the share sale agreement. If you're the seller, then you have to be comfortable with the warranties that you're giving and that they are accurate. And if you're the buyer, you want to manage risk by making those warranties robust and making those indemnities as tight as possible. But we see, in the practical world, sometimes these things don't always end up, doesn't always end up going smoothly, and there are disputes about these things. I wouldn't say occasionally; they may very well be regularly. What are some practical ways that this can be managed?
Yeah, so obviously ensuring that you have the right advice, whether that's as a buyer around your due diligence, making sure that you're covering off all the key risks, or as a seller, making sure that you've got the benefit of the customary qualifications and limitations in a sale agreement. There are various reasons why buyers and sellers may wish to consider what's called warranty and indemnity insurance, which is basically a form of insurance provided by specific insurers that covers these same risks that we're talking about in warranties and indemnities. It was, until recently, prohibitively expensive for deals kind of under 100 mil or even 50 mil, but we are gradually seeing it become more affordable even for smaller deals, to the point where it should at least be considered on a range of transactions as an option, depending on the type of premium that can be offered for that particular deal.
Excellent. Now let's get to the exciting bit, and that's signing and completion. There's always a sense of excitement in the air when we reach that stage, and anticipation, and maybe the client's already picked out their Porsche or their new yacht, or their new holiday house, and can't wait to sort of get their hands on that big pot of money. But let's talk about signing and completion, and importantly, what's the difference between the two? Because I think that's something that took me a while to understand. So maybe you can help make that a little simpler for us.
Yeah, it's always a concern when the client's gone out and bought their Porsche on signing and prior to completion. That always makes you a little bit nervous. But it's an important distinction, and a weird one for those that aren't familiar with it. So you've gone through your due diligence, you've negotiated the sale agreement, it's finally agreed, you've got through all those warranties and indemnities, etc. And the sale agreement's signed. But unfortunately, for most deals, that's not the end of it. There'll typically be a process to work through to get to what's called completion, or as the Americans call it, closing. And typically it involves the satisfaction of certain conditions precedent from the sale agreement, and that might be third party or regulatory approvals that need to be provided. It might be certain other documents being agreed and signed, like an employment agreement or an assignment of IP. And all of those things need to happen, and both parties need to be satisfied that they've happened before completion can occur. So signing is really just that, signing of the sale agreement. Completion is where all the magic happens. That's where the buyer hands over their money, the seller hands over the business or the shares, and people can start popping champagne and buying Porsches and doing whatever else they would like to do to celebrate.
Yeah, and we can take the client out for a big lunch. But
exactly.
Excellent. So just two more things to wrap up. One is about timing, and one is about the sort of team you need for a deal. But I mean, in your experience, a typical M&A deal, assuming it goes smoothly, what sort of time frame is reasonable, and what should people expect?
Longer than they would expect is the short answer. From starting on a term sheet to completion, you're probably looking at anywhere between 2 and 6 months, depending on things like regulatory approvals and third-party approvals. But of course, there are exceptions either side of that, but that's what we customarily see.
We've had a recent experience, James, of getting instructions in mid-May for a 30 June completion, yeah, it's often a time to try and temper or hose down the client's expectations about just how quickly these things can be achieved. Not necessarily because of all of the things we've talked about, but importantly because of some of these third-party issues, and especially the inevitable curveballs that will arise when you go through due diligence and negotiating the terms of the sale agreement and so on and so forth. And another, and my final question, so just around process. I mean, if you're a person who's thinking about buying a business, or if you're a person who's thinking about selling a business, what sort of team do you need to get around you? Who's involved, and what sort of advisors normally play a part in the deal?
Yeah, that's a really important question, getting the right team around you. In addition to lawyers, at a minimum, you should have tax and financial advisors who can assist with financial due diligence and advise on the accounting and tax aspects of the deal. Sometimes corporate advisors or business brokers will be involved, not only to source potential buyers of a business, but to provide strategic input on pricing and structure, and to manage deal timetables. And sometimes, particularly for due diligence, buyers might look to engage industry or subject matter experts to drill down into areas that are particularly technical, complex, or high risk. So that's probably the core team. And yeah, if you get that team together early, set it up well, get the right people, then I think you're pretty well placed to end up with a good result.
Excellent, James. Well, thank you so much for sharing all of that information with us. I don't know that we necessarily demystified every single little bit of jargon. We would need hours to do that, but we've really hit on some important points. And a couple of the most important things for me is, in doing an M&A deal, expect the unexpected, and get ahead of those issues that might blow out timetables, because you or the client won't be involved or won't be controlling the timing of those, like the third-party consents, like the regulatory consents. Understand the process, understand the structure, understand where the pain points in the whole process will be, and keep your clients calm and in control, and fully aware of what are reasonable timeframes. So thanks very much for that, James. We've really appreciated you sharing your expertise. and your thoughts with us on this podcast. And in the second bit of this, we'll be picking up on some of the points that we've talked about in this presentation, and looking at some specific tax issues arising from a typical M&A process, both in the pre-deal stage, during the deal stage, when some of those risks start to arise, and then post-completion.
Thank you to our listeners for listening to today's podcast. We trust that the information today has been useful, and as always, please get in touch with anybody in the team if there's any aspect that you would like to talk about further. You can find all of our details on our website, which is www.hallandwilcox.com.au, or you can connect with Hall & Wilcox or the tax team through LinkedIn. And if you enjoyed today's episode, and you no doubt have, then we would be most obliged if you could rate, review, and follow our podcasts wherever it is that you listen to your podcasts.
Talk to you next time.